Hi all. Every investor has a doubt. What is this fundamental analysis? Is it so difficult to understand? No. Actually, in this video, we are going to see 5 basic fundamental analysis to choose a stock. First one, sales and revenue growth. You just go to Google and you search for some websites where you will get all the details about a company. Say for example, we have a screener.in, we have grow.in, likewise there are many websites. So you can choose one and just check these 5 indicators alone. Number 1, sales and or revenue growth. So a company, minimum it has to have 10 to 15% sequential growth. That is, if you are watching quarter on quarter growth, or it is year on year growth. Okay, so that's called sequential. So if you compare with last year earnings and this year earnings, the sales or the revenue has to have minimum increased 10 to 15% at least. Then it is a decent growth stock. If it is more than 20%, then it is going to be a much better stock which can give you good returns. And a 5-year average growth. In many websites it will be given as CAGR. If it is more than 10%, also it is a good company to buy in. So this is the most first important criteria. The sales has to increase. Now we go to the second. Profit growth. Some companies actually in the early stage of their business, they will show loss making. So that's why you have to wait for profit growth to come in after like 2 years, 3 years. Likewise, you have to see at least a 5-year track record of profit growth. If the profit growth is 15 to 20% sequentially, then it is a very good growth. Sometimes the stock have 20% growth in profit, then these are the companies which are a multi-bagger in the long run. And a 5-year CAGR of profit growth has to be more than 15%. In history, many stocks has given huge rallies and returns to the investor, which generally have this 15% as their CAGR profit growth. So as I said, in 1 or 2 quarters, if the company is making loss, that doesn't mean that the company is not a buy. No, not like that. You have to see the other indicators, particularly the sales. Increasing sales, but 1 or 2 quarters loss is a negligible factor. But overall, in 2 to 3 years or even 5 years, the growth has to be parallel in both the sales and profit. Then the third point, debt to equity. So what is this debt to equity? Say for example, I have 100 crores of equity capital, but I have 150 crores of liabilities in the form of loans and other things. So now this ratio will be working at debt to equity will be at 1.5. So my debt is higher than the capital which I have. So that is not actually a good sign for a company. So this debt to equity, this is also easily available in most of the websites you can see. If the debt to equity is less than 0.5, then it is a very low debt. So the company has high liquidity. If it is near 1, less than 1, something like 0.8, 0.9, then it's a manageable debt. So in both cases, it's a good company to hold or buy. Only when the company is having a debt of more than 1, then it is going to be an alarming signal where we have to check other parameters whether it is currently a huge debt is now there, but the company is giving a confident that in the next couple of quarters you will reduce the debt. Likewise, we have to see the management commentary on it. So usually if the number is higher than 1, slightly it is a high risk. Okay. And the fourth point, promoter holding. Why we have to check this promoter holding? See, usually in our India, the rule is that the promoter holding should be less than 75%. That is, at least 25% should be given to the retail public holding. Now, if the promoters are holding around 50% or higher, then it's a good company. Okay, they are holding, and that means that they are holding it with confidence. There will be high liquidity in the market also, secondary market also, it will be highly liquid to trade. But we have to check this at least once in a year, because if the promoters are going on gradually decreasing their stake, yearly like they had 75%, the next year they reduce it to 65, the next couple of years they go for 50 likewise, then that means the promoter is not interested in holding the company itself. He is just selling it through open market or other route, and he is reducing the risk of owning his own company. So that's why we have to look at whether the promoter holding is like any decreasing or increasing. If it is increasing, then it's a good sign. So this is the fourth one. And the fifth point, most important and a little bit confusing one, PE multiple, that is price to earnings multiple. A simple formula is stock price divided by earnings per share. You can just check in any website, you Google it, earnings per share of the company XYZ, you will get the number. So divided by the current market price, there you get the PE multiple number. Generally, any sector or the stock which is having a low profit growth, say for example the profit growth is just around 10 to 15%, less than 10-15%, then 20 PE multiple is actually a fair valuation. Anything beyond or above 20 is subject to high valuation. But a company which has 15-20% jump in profit, there you can give that company valuation around 40 PE multiple times. Okay, so even sometimes it can even jump to 45 or 50 likewise, because the company is earning high PE multiple. Sometimes like many broking companies or analysts will say this stock is trading at 100 PE multiple, so do not buy, it's a very high valuation. No, not like that. Just don't watch the PE multiple number alone. Watch what is their profit. If their profit is jumping more than 50% sequentially, then that means this stock is still at 100 PE multiple trading at fair valuation. You can even buy that stock because the profit is jumping 50%. But the same stock or any other stock, if the profit is jumping only 5 to 6% or less than that, even if the stock is trading less than 10 PE multiple, then that stock is going to be a high valuation stock. You should not buy that. Some stocks like the brokers and analysts will say that this is trading at only 5x PE multiple, 4x. You buy now, this stock is going to go to 50 PE multiple and you will get a multi-bagger. No, not really. You have to see the revenue and profit growth. So, and the most important point in PE multiple is you have to check the sector PE multiple. Okay, so this sector PE multiple is a general average of how the other stocks in the same sector are trading. So if the sector PE multiple is at 50 and this stock is trading at 20, then it is a cheap attractive valuation. Vice versa, if the sector PE multiple is 20 and the stock trading at 50, then that means it is trading at a higher valuation. So under PE multiple, you have to look at these category only. So that's it. So these are the 5 important points. Remember, sales, profit, debt equity ratio and promoter holding, and the final number is PE multiples. These are the things under fundamental analysis you have to watch for an investor to just buy a stock. Buy all.